for the Fed, when they say we don't look at the equity market, they might be making a mistake in not looking at the equity market in some ways, like the 99 2000 episode, when risk assets are doing what they're doing and flying, and speculation is starting to pick up in riskier parts of the markets. They need to pay attention because it can actually be proven that it has a positive impulse on inflation. That was surprising to me. Now, the other aspect is, the dollar. So why is the dollar, weakening as much as it has been? It's interesting because if you look at, for example, the front end of the curve is what typically dictates the dollar, not the 10-year, not the 30-year. And when you look at the front end, we have priced 75 bips more of cuts by the end of 2026 than we had in February, in spite of the CPI swap market pricing a higher inflation profile. Okay, so you look at something like 2-year, 1-year, you can break it out to OIS rates, which is like the equivalent of Fed funds. That has moved sharply lower, while we're increasing the inflation swap expectation, and that effectively implies a negative real rate, or a downward move on real rates, which is typically very negative for the dollar. Now, the dollar, when it weakens, tends to be positive for the equity market. Like, as I said, 30% of revenues come from abroad. That translates much better when you have a 10% weakening in the dollar. And it improves liquidity in the system, the supply of dollars to not just US, but around the world. And then last but not least is it raises directly import prices, right? So the US is an import-driven economy, buying things from abroad. That means, the dollar being weaker, things cost more. Things were just going to cost more. And as a result, it has a positive impulse to inflation. Now, when we originally were looking at trade wars, we were assuming that the dollar would strengthen to offset the impact from tariffs, but we're seeing the opposite. And so it's adding to it. And so, I have a chart that I brought with you that shows the impulse from the dollar to inflation just spiked in Q1. We don't have Q2 data yet because we'll get the GDP report tomorrow and we can update it. But even since Q3, we're seeing, until the last 2 days, the dollar selling off, and you see a big impulse to inflation from the dollar. The 10-year was actually the most complicated. And in the 10-year, it actually depends on what's driving the 10-year higher. So this was very surprising to me. In my prior loop framework, it was 10-year up, that's a tightening. Turns out it's not that simple. The 10-year can go up for one of three reasons. It can go up because real rates are going up, growth is improving. Well, then 10-year goes up, but so do equities, and you actually don't get a tightening. This is actually, the 10-year is just reflecting better growth profile at this point. It's not imposing a tightening. You can get the 10-year going up because inflation expectations are going up. That is a different impact. That has an impact that's positive on inflation and negative on growth. So here you have mixed reactions from the 10-year moving up. And that's what we've seen for the most part this year. And then the last one is the term premium. The risk premium for holding bonds goes up for whatever reason, because their deficits are too high or whatnot. Then you have a situation where it imposes downward pressure on both growth and inflation. So when we decompose all of this, it's really interesting because the 10-year is higher than where we have been the last couple of years on average, but it's actually a neutral impulse for the most part due to the differences between inflation expectations going up and the term premium going up. They're kind of offsetting each other. The equity side is quite straightforward, but it's the dollar that is having this huge impulse on not just growth, but inflation. And so I think, that's where the Fed should really be. They haven't talked about the dollar at all. And I think they need to be talking about the dollar. it actually goes into, the doom loop, thesis that I brought on your show last time, where this could run away from them if the dollar, really cascades on it. And that's where I think if they cut inappropriately when the economy doesn't need it because they just think neutral is lower or whatever, the dollar would be the big reaction function, and that would raise inflation, really aggressively on a going forward basis. So really just fascinating to be able to have all these different impulses and impacts, and then aggregate them together to look at the overall economy. But it just gives me a substantial edge relative to my prior framework in knowing how to position myself, for the immediate future, in